report, the 18th of December 2024. Right, today I'll talk a bit about the Fed decision looming, okay? The navigating the rate cuts, economic resilience, and political uncertainty. First of all, the S&P 500 has plateaued. If you notice, it has been trading sideways for a couple of days. In fact, near its all-time high for the past 7 trading days, as investors anticipate the Federal Reserve's final meeting of the year scheduled for 18 December at 2 p.m. Eastern Time. So that's in a couple of hours' time, right? Now, this meeting comes at a crucial time, with markets closely monitoring the Fed's interest rate decisions and its projections for the economic outlook in 2025. Now, according to CME Fed Watch 2, there is a 95.5% chance probability of the Fed trimming its interest rates by 25 basis points, reflecting a near unanimous expectation for easing monetary policy. While the rate cut itself seems largely priced into the market, the primary focus will be on the Fed Chair Jerome Powell's comments during his press conference at 2:30 p.m. Eastern Time. Now, Powell's insights on inflation, labor markets, economic growth will be key to understanding the Fed's approach to monetary policy in 2025. Now, economic data leading into the FOMC meeting. The latest economic indicators paint a picture of moderate growth, resilient labor market, and steady inflation. I prepared this chart for you all, as you can see from here. So what are the key observations? Labor market non-farm employment surged to 227,000 in December, recovering sharply from 36,000 in November. Now, all these are revised numbers, yeah? I did not take the one that was printed on that day because as you know, certain data, they always have revisions, and every single one of these are revision numbers, okay? So despite volatility, unemployment remains steady at 4.2%, suggesting resilience in labor market. Now, they were saying that unemployment tick up by 0.1%, but if you look at overall, the last few months, and you compare them, it's just about the same place. Okay, that's why I say remain steady. Now, GDP growth, quarter 3, GDP growth finalized at 2.8%, right? That's for September. And we are awaiting that GDP number that's also going to come out soon, reflecting sustained economic expansion driven by consumer spending and business investments. Now, the inflation, the CPI and core CPI remain stable, with inflation trending slightly upwards in December to 2.7% year-on-year, signaling a gradual rise, but still within manageable range. Okay. Retail sales had bounded sharply in November, 2.85%, right? Suggesting consumer spending remained robust despite higher interest rates. Now, this definitely an increment from previous months, like October, you had 1.98% and September, 2.16%. So at the end of the day, I think the most crucial thing is the Fed's dot plot and interest rate expectations. Now, the summary of economic projections will play a pivotal role in this meeting, particularly the dot plot, a visual representation of Fed policymakers' expectation for interest rates. Now, in September, the Fed's median forecast anticipated the federal fund rate ending 2025 in a range of 3.25% to 3.5%, with 4 rate cuts projected. Now, this was the September one, okay? So we are waiting for the December one to see how much this has changed, okay? Because the sentiment has shifted. Now, according to Bloomberg data, markets now expect only 2 rate cuts in 2025 as economic resilience and inflation risks have tempered expectations for aggressive easing. Any deviation in the updated dot plot, such as fewer rate cuts or higher terminal rate, could significantly impact market sentiment. All right. And as usual, we also have political risks preparing for a Trump presidency. A potential Trump presidency in 2025 introduces additional uncertainty to the inflation outlook. Trump proposed trade policies could exacerbate price pressures because 25% of tariffs on imports from Mexico and Canada will be effective on January 20th, Inauguration Day, because this is what Trump said. This policy could disrupt supply chains and raise costs for American businesses and consumers. 10% tariffs on Chinese imports, further escalating trade tensions. This move would raise the price of a broad range of imported goods. While Trump has vowed to tackle inflation, these tariffs function as consumption taxes, which businesses often pass on to consumers, leading to higher prices. Economists warn that such inflationary pressure could force the Fed to adopt a more cautious stance in cutting rates. Instead of aggressive easing, the Fed may take a wait-and-see approach to evaluate the long-term inflationary impact of new tariffs. This you can't run away because it's the prudent thing to do. Now, US stock market and dollar implications. At the end of the day, the Fed's decision and Chair Powell's commentary will shape investors' sentiment for both equity and bond markets. Key focal points include clarity on rate path. Market will closely watch Powell's guidance on interest rates for 2024 to 2025, moving into there and comparing them. And any signals of inflation risk could dampen hopes for rate cuts. Now, consistent job growth may reduce the Fed's urgency to ease monetary policy. And most important, a hawkish tone from Powell indicating fewer rate cuts could trigger a pullback in equities, while a dovish outlook might propel the S&P 500 higher. The opposite holds true for the US dollar. Okay, so let's wait for the results. And once I digest that, I will present that in a report on Friday, and then we can talk about it more then. So with that, that's the report for today.